We find that when a borrower is in trouble, a bank is more likely to lend a loan to a related party of that borrower in trouble, and that related party transfers that almost equivalent amount of money to this borrower.
Banks are able to window dress their books in the sense that they are able to show that they are lending to good borrowers.
Actually, we are happy that RBI thought about indirect evergreening.
Yes.
But this kind of blanket ban, otherwise what you're doing, as Nishant explained, you are killing the genuine investor. Hello all, welcome to Finterpret. This is Prasanna Tantri. I teach finance at ISB. Today we are going to start discussion on a paper titled Indirect Evergreening Using Related Parties Evidence from India. This is, I have co-authored this paper with Nishant, Kashyap and Sriniwas, Mahapatro. Both of us are PhD students, and Sriniwas is now graduating and going to teach in Rochester Institute of Technology. This paper is very relevant now given a RBI circular which has sort of restricted certain kind of lending, which we think is very related to our paper. Now, because the paper involves several steps and a little bit, it requires some background. Although we have shot it as 3 different episodes with Sriniwas and Nishant participating with me in discussion, we are going to club together and show you as one episode here. Usually our practice is to show a paper, dissect a paper slowly, wait for your feedback, improve on it and use it in the next episode. That was the whole purpose. But here we think that it is better to show them together. So you will have 3 episodes coming one after the other. That's why the timing, if you see, is also longer. So it will start with episode 1 where I and Sriniwas will try to understand the definition of evergreening and what do you mean and by these terms. Episode 2, Nishant will throw light on finding of the paper, and in the last episode we will discuss RBI circular and its implications and how it can be modified based on the findings of the paper. But remember, all of them are there in this video. Thank you. Now, you may be wondering why did you take up this topic of indirect evergreening and what we mean by indirect evergreening. Sounds funny, evergreening and indirect and what it has got to do with finance. So recently RBI came out with a regulation which sort of restricted banks from, they lending to certain financial intermediaries. Right. Some segment of the financial markets, they are called AIF. Alternate investment funds. We'll discuss what it is.
Yes.
And the reason behind this is RBI suspects that this route is used by banks to hide bad loans. This is the worry. Now, what's the connection between that and our paper? The point is our paper directly talks to this issue. Right. How banks hide bad loans, what can we do? And in fact, remember viewers, in the very first episode I said that a utility of an economist or a financial economist is not only in forecasting future. Rigorously examining past itself can be useful.
That's right.
So we have done 2 papers. We've shown the utility of rigorously examining what happened. Hopefully, this paper should convince you even more that our findings in this paper are directly going to talk to this policy. We are not only going to using the findings of this paper. We are not only going to examine the policy. We are also going to suggest some tweaks that we think are necessary. All of this is going to come directly from our findings. So Professor Sriniwas, feels nice to call you professor repeatedly. So now that you're going to be a professor, so you will do most of the explanation today. Okay. So can you explain, for the benefit of our viewers, what is this evergreening in the context of finance? Because it looks like some kind of environmental topic.
Right.
So what is evergreening? Can you please explain?
Actually, you're right. I mean, the literal English word means that a plant that never sheds its green leaves. It's called as evergreening. So in terms of banking, we talk about if a bank doesn't let the bad loans die or doesn't recognize losses from the bad loans, it is termed as evergreening. That is, it is trying to keep the loans alive. Through ways like either rolling it over or restructuring or funding it further, even though they know that a particular loan is perhaps not worth refinancing and maybe it should be just be recognized as a loss in the balance sheet. The banks keeps on doing it, keeps on fueling it. That particular.
So you're saying a case where they know that the borrower's business has collapsed.
That's right.
There is no hope of any recovery. So ideal case is to take a loss, whatever it is, and move on.
Right.
But instead they keep showing it as alive. Right. They don't take the loss. And how do they do it?
Well, there are several ways. One particular way could be restructure it. So, for example, at the end of the term of the loan, when you know that the borrower is unable to repay, the prudent thing would be to recognize it as a loss. But a bank might, what they can do is they can just restructure it, they can extend the term of the loan so to say another 3-4 years, and that gives another lease of life.
So 3-4 years, I don't have to recognize it as a loss.
Right.
I
For
just
that
give you
3-4
3 years more.
Yes,
And what other ways are there?
Other ways could be, you could either fund it, give another loan on top of it, or there could be even, subtle variations of it, like trying to fund this bad borrower through other means like related party transactions.
Okay, we'll come to that. I think you have to take a pause here. You said you can fund it.
Yes.
Right. By the way, viewers, you are an ex-banker yourself. I hope you have not done this. Maybe you are speaking from experience. It's actually coming so naturally. So let's not. I won't extract a confession
some
from
anecdotal
you.
evidence.
So I won't extract any confession from you today. You can tell me off camera how much you have done, but that's fine. So I think this funding you have to. I think it's not clear. What do you mean by funding? So let's go slowly. So if a borrower, you know that you as a banker know that this borrower's business has collapsed. Right. And the borrower comes to you. So what do you mean by funding? You're saying, I'm going to give another loan to this borrower and ask the borrower to use the same loan to repay an old loan.
Right.
So that's what you mean, right?
Yes.
Funding the loan.
So basically, I don't want to recognize this the old loan as a non-performing asset, which is like I take a hit on my balance sheet. So when the borrower comes, I can give another lease of life. I can give another loan. So he can use the proceeds of this loan to repay the previous loan, and this practice can actually, in some cases it can go on for a long time.
Okay, so only if the borrower is lucky, or if it's some temporary problem because of his business was shut, maybe they will be able to repay both the loans.
Yes.
But in most cases, because the business is dead.
Right.
So not only is your old loan gone, your new loan is also gone.
Yeah,
this
like
is where it's going to end in most cases.
Yes, like you are burning good money after bad.
Sure.
That could be.
Right. So this is evergreening. And why do banks do it? Because one day it is anyway going to collapse.
Right. I mean, for the time being, I don't have to show losses.
And some people can leave bank and become PhD students.
That's
And then
I was
somebody
not
who
in
is
that
there
kind of a
and then
position.
become professors and go somewhere. Is that one possibility?
I did not have the opportunity to be in that's the higher position.
Sure.
But yeah, I mean, like it's like you have the managerial incentives. You can like if I show it, I'll my bonus, my pay would be hit. And even the nobody wants to show poor balance sheet. And in fact, this can be more prominent when the bank has a bad balance sheet.
Sure.
So if you are already under pressure, say your capital adequacy is not very high, your financial statements are not that good.
Yeah.
You don't want to show even poor.
Yeah, because RBI can come and shut you down.
Exactly.
Okay, it can give you a temporary release of life.
Right.
Okay, so can you show it through some illustration of why this? How does this whole business of evergreening? How does it artificially show a better picture of a bank's balance sheet? If you can show it through a simple illustration, that will help.
Right. I have created one such example.
Yeah.
So I'll.
I know that. That's why I'm asking you.
Right. So let us assume a very plain balance sheet, plain vanilla, like not much stuff. You have the asset sides and the liability and the equity sides. So this is basic accounting 101. The liabilities and the equity sides are the sources of funds. So basically for banks it is you get deposits and you have some of your own capital. So for simplicity I have taken it as 50 lakhs each. And then you take these sources of funds and you lend to borrowers.
Right.
So you are lending to say 10 firms, 10 lakhs each.
Sure.
So this is your balance sheet.
Sure.
Now imagine that out of these 10 borrowers who have been lent 10 lakhs each, 3 of them are in bad scenarios. Say their financial statements are very bad, they are making continuous losses.
Yeah, the business has collapsed.
Yeah, business has collapsed and there is very less likelihood that they will repay you back.
Right.
So roughly it is like 30 lakhs worth of loan,
Sure.
which is going under the water.
Sure.
So if the bank is really transparent or prudent, what they would do is they will take a hit of 30 lakh on their assets, saying that these have gone down, the value is 0.
Okay.
For simplicity, let's assume that there is no recovery and stuff.
Okay.
Just for this example.
Right.
So my asset then goes down from 100 to 70 because
70.
I'm taking a loss of
Sure.
30. and this loss will also show up in my equity, so my capital is going to go down.
Yeah, because the owners should first take the hit.
Right.
And it's not depositors.
Right,
That's a basic
right,
principle.
right.
So it will, what you're showing as retained earnings is basically a hit on the capital.
Right,
So capital effectively becomes 20.
20.
So 70 rupee balance sheet, 20 capital, 50 deposit.
Deposits. So this is how it should look like when there is no evergreening.
Right.
Now let's come to the scenario when there is a bank does a kind of evergreening where they restructure their loans.
Okay.
That is like we talked about an example that it kind
Give
of
you more time.
extends the term.
Yeah,
Right.
things
So in that case, you do not have to show the loss right away.
Right.
So then the asset side still remains 100 because it's just that the 30 lakh worth of loan, now the tenure has increased.
Sure.
And similarly, there is no hit on the, there is no losses that you recognize. So the asset and liability sides look 100 lakhs each.
Right.
But in terms of bad loan, actual bad loan, you know that there is 30% of the loans, that is 30 lakhs out of the 100 lakhs, is actually bad quality.
Right.
This is specifically clear if you are like an analyst or let me say an auditor who goes through the bank balance sheet in detail
And finds out who the borrowers are, what's going on. Yeah.
and they can check whether the borrower is really has gone bankrupt or something like that.
But most people will not know, right? They will
Yes.
go by whatever the bank has reported. And the bank has reported 30 rupees, all are fine. And in fact, you said another way, right? It's not just restructuring. They can ask these people, 30 people, to somehow take a temporary loan from their friend and repay it and then give it back to them only.
Right.
So
right.
that also shows they have, everything is fine.
Exactly.
Hunky dory, no default.
No default.
And everybody's happy.
Right.
In fact, you can recognize income from those loans.
Yes. Yeah.
Right?
Yeah.
So you will have higher income, good loan growth and
Right.
all of this. So
Right.
this is the problem.
This is the
But you said a good auditor or an analyst can figure this out.
Right.
Right? So
So like a good auditor who really goes through each of the loans and tries to see how is the health of the borrower, whether the borrower is doing good, whether the credit worthiness or whether the borrower can repay. So if somebody really does that kind of an analysis, which I'm sure a lot of credit analysts and equity analysts must be doing, at least on the large ticket loans, they'll find out that a lot of loan is going to go under the water, and they will they can make these adjustments even though it doesn't reflect in the financial statements. They will do their own calculation saying that 30% of the loans are going to go back.
I know you are from accounting background and you are very sympathetic to auditors and analysts. We are not. That's fine. We can beg to differ on this. But having said that, if it is detectable, does that mean that there is, where is then, can you explain then what is this indirect evergreening that we're talking about?
Right.
So is it because this is detectable, banks have come out with more innovative ways, which is very difficult to detect?
So there could be innovative ways of doing this evergreening where it becomes that much harder for say the regulator or the auditor to catch. One such way is in indirect evergreening through related party transactions. It sounds something fancy, but
You're a bit underplaying it. But actually, our paper is the first one to talk about indirect evergreening.
Yeah, that's right.
I think although in practice this was there, people knew. We don't claim to have discovered this whole phenomena, but I think properly documenting systematically, I think ours is the first paper. So please explain what is this indirect evergreening and why it is hard to detect.
Right. So I'll get your focus on this slide.
Yeah.
So basically, you have a bank and say 30 lakhs worth of exposure,
Same
which
case.
is towards the bad borrowers.
Right.
Now, rather than relending or trying to extend the tenure of this loan, what the bank can do is the bank can give a new loan of 30 lakhs to a related party of the existing bad borrower.
So by related party, you mean what? A subsidiary that is created?
Right, like a subsidiary, associate, or some joint venture, or basically any company.
It could be a friend's company or anything that they have created.
Right.
So that's a new company.
That's a new company.
So no auditor, no analyst should have problem with that company.
Right.
It looks good, very clean, no past defaults, nothing.
Exactly, because on the bank balance sheet, it will look like a new loan.
New loan, and the company is also clean.
Exactly.
Right.
So now this related party can actually, send this proceeds of the new loan back to the, original beneficiary, which is the existing bad borrower.
Okay.
And in turn, this bad borrower can repay the loan.
Okay.
So in essence, what is happening is, although this borrower is still bad, it doesn't have the means to pay. This new loan has been round tipped just to refund the old bad loan.
Ultimately, bank's own money is used to pay its own loan back.
That's right.
So
That's
this time it's a bit more complicated way.
Yeah.
Instead of directly giving it to you and taking back from you, and which you said your so-called auditors are very careful, and I grant it to you. But this time instead, what I've done is I've given loan to say Nishant.
Right.
Let's bring him our co-author,
Right.
and then he will give that loan to you,
Right.
and you prepay the loan,
And I prepay it.
and he's clean, so no
He's clean.
auditor cannot detect.
Yeah, and if I go to the same balance sheet example, now what it shows is rather than 100 lakhs to existing borrowers, it shows 70 lakhs to existing borrowers,
Right.
because 30 lakhs have been repaid.
Right.
And how have they been repaid? Because you have given 30 lakhs new loans to related parties.
Yes. So now there is no loss.
No loss.
So money has come back,
Yes.
and then you can use it to somebody, lend it to anybody else, and whatever you can show.
Right,
You can show
right.
30 lakhs of new loans.
Right.
So now the reason why auditors, and let me guess, and correct me if I'm wrong, I know you are the accounting guru here. So reason why it is hard for auditor to detect is that auditor will not have access to what has happened between that related party which got this loan
Right.
and the original, your original sinner,
That's right.
the defaulter.
That's right.
That auditor, why will the auditor have access?
Why will they? I mean, they would most likely look at, okay, these are the borrowers, they have very good credit worthiness, and they have got new loans.
Right.
It's very difficult to really go and see what are the network of firms, how it gets.
Even if there is network, you think, even let's say they know that there is some party that's connected, but they will not have access to transactions between them.
That's right.
They are not auditors to that
Right,
company. They are auditors to this bank.
Right.
Even analysts are unlikely to look at it.
Exactly.
So you think this is the way. So this gets sort of undetected.
Right.
But economically, consequence is the same.
Yes.
Ultimately, you're going to loan to a bad borrower.
You are giving a loan to, you are not recognizing the loss. And on top of that, there is another issue. Like this 30 lakhs loan, this new loan, it could have been given to a better borrower who actually deserves the money.
Yes, yes. And then they will create employment and investment
Exactly.
and all kinds of stuff. So this money is going to this so-called zombie. Actually, the money is lost. So this is all accounting. Money is completely lost, but it is shown as if there is some resource. Right? Now, do you have any evidence? I think we have looked at it, right? It is actually, we keep saying it's hard to detect, right? I think we looked at the RBI inspection and can you talk about it?
Right. So RBI did do a rigorous kind of exercise of going through the bank books and asking them to report non-performing loans when they didn't. So in that exercise, they caught hold of a lot of restructuring activities. But when we did a similar analysis in terms of indirect evergreenings, a lot of indirect evergreenings were not actually
yeah. So the banks which resorted to this clever way of evergreening, they were not caught by the regulator. So those poor guys who did the direct way of evergreening, they were caught. Right. So this is a more dangerous and more damaging way of evergreening, and which is what RBI is worried about now. The viewers, the regulation that I spoke about initially is actually to curb this indirect way of evergreening, which is what our paper talks about. So indirect evergreening is far more dangerous than direct evergreening because there is a third party involved, and it's very hard to detect for reunion. That's the central point that you're making,
yes,
right?
Yes, because it's and this is just one way that we are talking about.
Right.
Now, as you're saying, RBI has thought that there is another way in which they could be done.
Using some financial intermediary.
Some financial intermediary. There could be numerous ways, but it's very difficult to find, and that's where. And I think ironically, when we saw that which were the banks that were doing it the most. In during the 2015 to 18 time period, we found that Yes Bank actually
Did
did
Lakshmi Vilas Bank
and Lakshmi Vilas Bank. These two were the ones which had a higher proportion of indirectly evergreen loans as compared to their peers.
So the way you say many ways, it appears like a practitioner actually was practiced this art talking about it, but I will not press you further on this. So Professor Sriniwas, so what is the relationship between this and our paper? Right. So we said we talk about indirect evergreening and auditors cannot detect and we detect. So can you explain what is our main finding, and we will take it forward from there.
Right. So basically in our paper we empirically examine what is does really the probability of giving a loan to a related party increases when the original borrower is in distress.
Right.
That's what we find. We find that there is a higher likelihood that the bank will give a new loan to a related party when the original borrower is in distress.
Okay.
So this clearly signs that.
So if you are in trouble, I am going to give a loan to Nishant.
Right, and
This
that
what
is
we
fishy,
find.
right?
That is, do you stop there? Don't we examine transaction between Nishant and you?
Yeah, that's the next step that
Right,
we do.
right.
What we do is then to confirm our fear, we just check whether there is a higher probability of a fund transfer from this new borrower to the existing borrower.
Right.
And we examine and we see that yes, there is a significant chance that this new borrower will transfer a high amount of fund to this existing borrower.
So we actually detect this phenomena, which we are saying plausibility.
Right.
That we find that when a borrower is in trouble,
Right.
a bank is more likely to lend a loan to a related party of that borrower in
right.
trouble, and that related party transfers that almost equivalent amount of money to this borrower. And do we also have some evidence of the third leg, because you said 3 steps are required,
Right.
and this borrower has to repay the loan?
That's right. And then in the next step, the borrower actually does it, although the borrower doesn't have good financial
Right, right.
statements or good financial conditions, it is able to repay the loan. So there is a high likelihood that this money,
Yeah.
which was routed back through related party transactions, is being used to repay the loan.
This is the total
Yes.
finding, right?
Yes.
So viewers, we will continue discussion on this. Thank you so much, Sriniwas, for explaining the main finding of the paper. So we'll get our partner in crime, Nishant, next time, and we'll explain how do we actually establish this, and what tests we have done, and what are the economic implications of this, and more importantly, what is the relevance of it to the RBI circular. We will also explain RBI circular, and what do you think our paper has to say about the circular, and how circular, what tweaks may be necessary to this policy based on our findings. So thank you so much. We'll come back next Friday on this.
Thank you.
So can you just start with explaining this phenomena, and what's the kind of economic magnitude that we find?
Yes.
So, and then we can continue from there.
Yes. So just to remind the viewers about the kind of transaction that happens in this particular road.
Right.
So there is a bad bank, there is a bad borrower, existing borrower of that bank, and there is a related party. The third member in this transaction is the related party of that existing borrower. So now, how this evergreening happens is the bad bank lends to the related party of that existing borrower, and the related party makes a transaction to the existing borrower.
Correct.
So what we find in the paper is that there is a 7% higher likelihood of this bad bank making a transaction to the related party
Of a troubled borrower.
For the troubled borrower.
Yeah.
When the existing borrower of
Is
that
in trouble.
Related to that particular related party is in trouble.
Okay.
Now, for the second leg of the transaction, the second step of this transaction, what we find is that there is a 19% higher likelihood of the related party transferring this proceed from the loan to the existing bad borrower
Okay.
of that bank,
Right.
and when these particular conditions are met.
Okay. I get it. So
Yes.
if just to summarize, what you're saying is, let's say I have made a loan to you. I'm a
Yes.
bank and you are a
Yes.
borrower.
Yes.
When you are making losses, when you are in trouble,
Yes.
there is a 7% higher chance
Yes.
that I will give a loan to your related party. When you say 7% higher chance compared to me giving loan to anybody else like this.
Right.
Right?
Yes.
So then you are saying subsequently that related party, which could be a shell company that
Yes.
you created,
Yes.
or I and you together created,
Right.
has a 19% higher chance
Yes.
of giving a loan to you compared to any other related party or any other entity.
Yes. Yes.
So this is what we find.
Yes.
So this we are saying is sort of suspicious,
Yes.
right?
Yes.
But someone can come and say that that maybe this is a genuine transaction. Maybe I found that other borrower to be a good borrower. The other borrower had some investment projects.
Yes.
That's why I made a loan.
Yes.
And the related party transaction between that party and you is also a normal business transaction, right? So how do we counter that? Can you explain?
So to counter that, what we show is, so whenever a firm takes a loan from a particular bank, it is for some purpose, for maybe investing in some infrastructure or some fixed asset, or maybe for their working capital needs.
Sure.
So what should happen is, whenever this kind of loan transaction is made from a bank to a firm, you should see the output in the form of investments being made by that particular firm.
The borrowers.
The borrowers of that
Right.
borrower in that transaction.
Right.
But what we find here is that when such transactions, such indirect transactions are made, in that case, both the related parties and the existing borrowers, the troubled existing borrowers, investments actually go down
Okay.
subsequently.
They
after
don't
taking
increase.
that loan. They
So
don't make
the
investments.
point
on
you're
that.
making is that related party which borrows from the bank does not invest that
Does
money.
not invest that.
Okay, somebody may say, okay, they have passed it on to that initial borrower, that you in this case.
Yes.
But you are also not making an investment.
Yes.
So, right?
Yes.
So basically what is happening is that money is getting laundered and coming back to the bank.
Yes,
Right?
exactly.
So can you discuss evidence that shows the whole cycle?
So we complete that cycle by showing that. So what should happen now is that if the existing borrower is using that loan to pay back their existing loans when they are in trouble, then the default of that particular existing borrower, even though that existing borrower is in trouble, they should be less likely to default after that transaction has been made
Right.
on those loans.
Right.
On the other hand, this related party, because the related party has just used that loan to transfer it to that existing borrower, the related parties subsequently should default on that particular loan. And we find that. We find that in spite of
Just
being
hold on.
held.
You know, I'm thinking of totally banning this IIT, IM type people from the show. So you're making, this is a bit complicated. Me and Sriniwas, poor accounting types, we were discussing it very comfortably. So what you're saying is, let me try to summarize.
Yes.
So let's say there is, I'm sure some of the viewers may find it a little bit complicated. So let's say there is a borrower B who is borrowing from a bank, A maybe, right? And this bank A, this borrower B is now in trouble.
Yes.
Right? They are making losses.
Yes.
Now bank A has lent money to some B1,
Right.
who is a fictitious entity that they have created.
Yes.
And this is and the B1 is passing on to B. This is a cycle.
Yes.
Now what you told me just that after receiving the loan, neither B1 nor B are investing this. Right?
Yes.
So this itself is suspicious.
Yes.
What are they doing with that money?
Yes.
And then you are telling me that you find evidence that that B person is using that money to repay me, the bank itself,
Yes.
A, because despite being in trouble, your default rates are lower than others in trouble.
Yes.
And also you are saying, now this new guy, the related entity who has borrowed, that guy is actually defaulting more.
Yes.
So basically I have shifted default from B to B1, right? This is the whole cycle you are saying.
Yes.
Now there could be a here also, right? So somebody can come and say that even this is a genuine transaction. There is a paper, as you know, with Radha Gopalan, Amit Seru and Vikram Nanda published in the Journal of Financial Economics, where they say that look, between these related parties, these kind of transactions are common.
Right.
They make this transaction to rescue each other.
Yes.
It is not inefficient because if one party, one group company fails, imagine one Reliance group company fails, all other Reliance companies get in trouble. One Tata fails, all other Tata, their reputation goes down. So maybe trying to save them.
Right.
So this is, they are borrowing. This guy, your B1, is trying to borrow from me and trying to save this B.
Right.
This is the whole thing going on, and you are calling it evergreening. And then RBI has read your paper and they are killing these loans, right? So people may accuse us of that.
Yes.
So what's your response to that?
So in that case, first of all, just before going into any kind of evidence, it is very clear that whenever such rescue loans are being made from B1 to B, B1 being the related party and B being the bad troubled borrower. In that case, this B1 should be able to finance this transaction from any kind of bank.
Yes.
Why only finance this transaction from a bad bank? In fact, they should rather approach a good bank to make that transaction.
Right.
So that is our first very strong evidence against this particular.
Okay, so you are saying this related party B1 is borrowing from me, A, who is your lender.
Yes.
And I am also in trouble, I am a bad bank. You are also in trouble.
Yes.
That related party is not approaching some other bank or their own bank.
Correct.
So if related party may have their other banks. No?
Yes.
They are not getting money from. So they are. Why are they getting money from your bank to rescue you?
Yes.
Right.
To rescue me.
So and we have tested whether they borrow from other healthy banks, their own banks.
Their own banks.
So some of your bank who are healthy.
Correct.
So they don't borrow from. Say you have let's say 3 banks.
Yes.
2 of your banks are healthy.
Yes.
They don't borrow from
They don't borrow from the healthy bank.
the healthy banks.
Yes.
And even this related party has a bank lending to them.
Yes.
They don't borrow from their
Their
bank,
own bank.
the B1 person. They are borrowing from unhealthy bank which is lent to bank.
Which is lent to the
So the reason unhealthy viewers is important because this unhealthy bank has a incentive to sort of hide default. That Sriniwas explained last time, right? And you also have an incentive to hide default, and that is why you suspect it is a sort of evergreen. And this is not a genuine transaction, right?
Yes.
So now tell me one thing that what about interest rates? So what do you find on the interest rate front? Because given that you are in trouble, are these done at high interest rates or how does it?
In fact, if I compare interest rates given in such transactions, such suspected cases of evergreening transactions, with interest rates given to similar firms as those related parties to which these transactions are made, we find that in fact compared to those similar borrowers, related parties in these transactions are getting loans at a lower interest rate.
So bank is not factoring in this risk. You know, fact that you are in trouble. You are getting a loan at a lower interest rate, right? So now, so this adds another sort of suspicion that this is some kind of a dubious transaction that is going on, right? So now a couple of questions that come. One is eventually you said this B1 eventually will default.
Yes.
Right now I am saving B's default.
Right.
Fair enough.
Yes.
But eventually this is a dubious loan. B1 has given money to B.
Yes.
B has paid it back to me. B1 has nothing to repay.
Right.
So eventually B1 defaults and you said that's what you find.
Yes.
Right? What did I achieve as a banker? Because today there is less default, tomorrow there is more default.
Yes.
So what does our paper say on that?
Yeah. So here we circle back to the to some of the advantages of evergreening that we had shown in the last episode as well. So our paper first very for any kind of evergreening transaction, the first advantage is that it helps bank postpone recognizing default.
Today you will look good.
But that can happen for any kind of evergreening transaction.
Right.
Why do this indirect route of evergreening?
Right.
So what we find evidence for is that banks are able to window dress their books in the sense that they are able to show that they are lending to good borrowers in spite of these loans being made for evergreening transactions.
After I made this loan to B1,
Yes.
if some auditor comes after us,
Yes.
if some analyst or someone comes after us,
Yes.
I can say, look, I have not not made
Right.
loan, and then let's say if I retire,
Yes.
and when this guy defaults,
Yes.
maybe somebody else will be there.
Yes.
Right? I am not there. You know, that time let them bother. Maybe that's
Yes.
one of the
Yes.
motives. But can regulators figure this out?
So yes, we also looked at that.
Right.
In fact, we had an advantage that during that same period in which we did our study, there was a special audit conducted by RBI.
The asset quality.
The asset quality review. We talked about it in the last episodes as well.
Right.
So what we find is that although this exercise by RBI, they were able to identify the directly evergreen loans, but they were not able to identify this circuitous way of evergreening through indirect route.
Okay. So they were able to identify those cases where Sriniwas' faith on auditors was sort of justified.
Yes.
He was very he was not happy that I was suspecting auditors.
Yes.
So the RBI could detect those directly evergreen. That means if I gave you loan directly, they found that out when you are in trouble.
Yes.
But they could not detect this. So that's why Yes Bank or Lakshmi Vilas Bank came out with decent marks after this audit.
Correct.
But then they imploded after a couple of years.
In fact,
right?
if even in our data set, both of these banks were in the list of those banks
highly
which had
evergreen.
made
So
such transactions.
Instead of this direct evergreening, which is direct test, simple test, if they had used our measure, our paper was not there at that time, so they could have detected this as well.
Right.
This is the practical implication of the paper.
Right.
So this is what we also emphasize. You don't need to know the future. You know, we didn't write the paper predicting what the banks is going to do.
Yes.
So the fact that this phenomena exists, there is a better measure of detecting it. That itself is useful.
Right.
So tomorrow, if they're going to do an audit, so they should use this measure also, and it's very easily usable measure, right?
Yes.
So the thing that they have to do is they have to detect whether a bank which is in trouble is lending to a related party of a borrower who is also in trouble.
Yes.
So if they find this transaction that is suspicious,
Yes.
then they look at all other things, investments, default, interest rates. Once all of these are in place, it's reasonable to sort of suspect that something may be going wrong here.
Right.
So that's the message of the
Yes,
paper. So
yes,
this is
yes.
one paper where people say these economists are all about explaining and all that. We are not just explaining, we are giving you a measure, we are giving you a tool which you can use,
Yes.
which regulators can use, auditors can use, analysts can use. Tomorrow if you are looking at a bank stock, you have to you can use this for analysis. That's the message of the paper. So finally, the issue about RBI circular, maybe next week I'll invite you again.
Yes.
We will talk about the RBI circular. Why is this paper relevant given the RBI circular?
Yes.
Right? So RBI circular viewers, last time I discussed, they have restricted lending to certain type of borrowers. Can our paper say something and suggest some modification to that? So thanks a lot, Nishant.
Thank you.
You were much simpler than before. Hopefully next time you will be even more
I'm
simpler.
improving a little. Yeah.
Now, Nishant, and I've been telling viewers about RBI circular and all that stuff. So what is this before you even get into this RBI circular, there is this term called AIF there.
Yes.
Right? We have to understand AIF to understand this RBI circular.
Yes.
So can you throw some light on this AIF business?
Yes. So these AIFs are, if you expand the AIF, the term, it's alternative investment funds.
Yeah.
So these are nothing but very similar to mutual funds, where they collect investments from various sophisticated investors here. In mutual funds, there can be many small ticket size retail investors.
Yes.
But here, because these are sophisticated investors, the ticket sizes or the amount of investments that are made
Minimum that you have to put in will
the
be
minimum
large.
that you have to put.
You can't just
are
put
very
in like
less.
3,000 rupees a month.
Yes.
Right.
So that's one of the major differences between mutual funds and these AIFs. And secondly, they also do not invest that money into plain, they do plain equity and debt, but the kinds of other alternative assets that they can invest in may range much more than what mutual funds do, where they plainly
So they invest in a very complicated manner. They give
manner.
you an
Yeah.
equity, debt, a combination
Some kind of
those.
combination.
And they can finance
yes,
innovation,
yes.
some new kind of projects.
new firms.
Mutual funds
Yes.
may stay away from that because they've taken money from ordinary, regular investors, and risk is a problem. And
Yes.
so these are like loosely, can I call them hedge funds in India? Some kind of hedge funds,
yes,
right?
you can
These
call
are
them.
some kind
Yes.
of hedge funds where
Yes.
they raise money from sophisticated investors and invest in
Invest in-
sophisticated manner,
Yes.
right? In complex securities,
Yes.
right? Okay, now that we know what is AF, so Sriniwas, can you explain this RBI circular? People, many people have asked me, you keep talking about RBI circular. What is this circular and how is it related to your paper, right? So can you explain what is this circular? Why did it create a lot of controversy and what is this whole business?
Right. So in December 2023, RBI they came up with this circular, but they said explicitly mentioned that banks, NBFCs, or any financial institution that is regulated by RBI, if they should not invest in any AIF, which Nishant explained, they should not invest in any AIF which invests further into one of those borrowers of the bank.
Okay.
So, for instance, if the bank has already lent money to say a borrower B, and they have invested in an AIF, that AIF, if the AIF invests in the borrower B, then they should stop this kind of investment.
Okay.
If they already have this kind of an investment, they have two options. They can either liquidate it in 30 days, or they should provide an entire provision for the entire amount of investments that they have made into the AIF.
Okay, so let me ask you. So let's say State Bank of India.
Right.
So you are telling me that State Bank of India, if there is a AF which is borrowed from State Bank of India, then that AF cannot invest or lend to any of the borrowers of State Bank of India.
That's right. If they do, then SBI has to provide full provision for that.
So then you said two options. If they have already done before the issue of circular, because that they would have doing.
Right.
So then you said two options. One is that that AF should ask for money back from the borrower,
Right.
who could have invested in some project or anything, or State Bank of India, when you say provide, should treat it as a loss,
Right.
right? An NPA,
Right. They
right?
should treat it
So this is what it is, viewers. So the issue is a bank cannot lend to a AF, which in turn lends back to a borrower of the bank, right? Now, the way it can be connected to our paper is that this AIF, RBI is treating this AIF as that related party,
Right.
which is used as a shell entity
Right.
to circle this loan back, right?
Right.
So that is what
Yes.
that is the way if you can relate this paper. So
So the purpose of this, of this circular was essentially to prevent any kind of indirect evergreening.
Right.
So if we circle back to what we discussed in indirect evergreening, we usually have this bank and the borrower, and you have you already have a loan, and one way of indirect evergreening could be the bank could give a loan to the related party, which again circles it back to the original borrower.
Yes, that's what it is.
Here the entity is actually the AIF. We are fearing that this AIF could actually be used in evergreening a loan indirectly, and their fear does merit, has merit, but yeah, I mean.
Yeah, so the RBI's worry is that that this AIF is being used by borrowers and banks to hide loans, bad loans, right? This is their worry, and as expected from any governmental organization, they've just banned the whole thing.
Right, they have banned the whole thing.
And not only they have banned, they said if you're doing it now, in 30 days you have to close the whole thing, right? So that's where we are. Right. So Nishant,
Yes.
so now if you think from our paper's point of view, don't you think this is, although it looks similar but very different?
Yes.
Because you were explaining a lot of filters that we put in.
Yes.
This looks like the assumption is everyone is a criminal.
Yes.
Right? Any bank lending to an AIF,
Right.
which in turn lends to a borrower of the bank, is assumed to be guilty.
Yes.
Right? They are evergreening, so ban the whole thing.
Yes.
Right? First of all, can you explain how there are conceptual issues with this? Just identifying, and then we'll discuss the likely consequences, because this should have some consequence as well.
Yes.
Right?
Yes.
So how does this differ from what we call as indirect evergreening?
Yes. So, for example, in our definition of indirect evergreening, the bank and borrower pair that was there, the bank and the existing borrower, the bank was in trouble, as well as the existing borrower was in trouble. Only then, in our paper, we said that only in those situations, these cases where the bank lends to the related
So the
party
first
of
point you're mentioning, there was a motive.
there was a motive.
Right?
There was a motive for
Both
the
of
bank.
them had a reason to
yes.
get into this transaction.
Yes, yes.
Now SBI and some random AIF,
Right.
why will they have a motive?
Why will they have the motive?
Some
Right.
small loan is nothing for SBI.
Yes, yes.
Right? Why should they lend to a random AIF and lend it to somebody?
Correct.
Whereas a big loan, and that's the first thing. So we establish motive.
Yes.
This circular doesn't bother about motive.
It doesn't.
Anything as
It
this.
doesn't.
Yes. Next, then.
So in fact, it also restricts the investment opportunities for the banks.
Yeah.
The
So
banks,
let's talk a little bit about that third entity also.
Okay.
Right? In our paper,
Yes.
there is the related entity.
Yeah.
Right? These papers go through this reviewing process.
Yes.
And a lot of times we got these referees and coming back to us telling, why will that related entity take so much risk? Because ultimately related entity is taking a loan and passing on to the initial borrower. There we explained that look, it's a group firm.
Right.
So both of them, the other guy defaulting has a cost on this firm also.
Yes. Yes.
Right?
In fact,
So
the Gopalan paper that we referred
that
to.
we discussed. It's exactly that.
Yes.
But in this case, do you see AIF is taking so much risk?
Yes.
It is taking a loan from SBI and passing on to some
it on to the
borrower,
borrower.
and tomorrow it will show up as a defaulter.
Yes.
Because that borrower is, if RBI is true, that borrower would have passed on money to me.
Yes.
Right? The AIF will be, then how will AIF pay back the bank?
Right. Right.
And therefore the compensation that AIF requires is crazy.
Right.
In our case, it's a group firm.
Yes.
So there is already inbuilt reputation. You want to protect the default somehow. So this seems so implausible to me.
Yes.
Even theoretically, that AIFs are being used in a systematic manner.
Yes.
Right? That's one issue with this.
Yes.
And you were talking about consequences. You were saying it will prevent investments.
Yes.
Can you elaborate on that?
So it provides the banks a route to maybe invest in these new age companies through AIFs.
Right.
That you are restricting for banks. Especially if you see the point that we were discussing about, in our case, there being a filter of bad borrowers and bad banks, and therefore there was a motive. In this case, in fact, it was found that HDFC made highest AIF provisions after the circular.
Right. That Sriniwas was saying
yes.
that if you already have a loan within 30 days, you have to recognize.
You have to recognize it.
So HDFC Bank. ended
That
up being-
was the
it was not-
and
it's one of
everybody
the
knows
best.
that it was one of the best in the industry.
Yeah.
So it gives you some kind of evidence, some kind of anecdotal evidence that maybe these are smart investments. Some of these are smart investments being made by the banks, and they are just using this AIF route as a way to expand their investment opportunities.
Okay. So you're saying it's quite possible that AIF is specialized. It's a
Right.
hedge fund.
Right.
It can identify and assess some business.
Right.
Banks directly cannot.
Right.
And banks don't want to take that risk.
Yes.
So therefore banks are channelizing this through AIFs,
through
and it is
AIFs.
not evergreening. It's
Yes.
genuine investment.
Genuine investment.
Now if you cut the whole thing, then this whole investment is gone.
Correct.
Right. So this will hurt this kind of
Yes,
investment.
yes.
It will hurt exactly the new innovative whatever the
companies.
government
Yes.
and everyone wants to promote. This
Yes.
is why when one arm of the government moves in one direction,
Yes.
they say that you can't follow a law without violating some other law. Accounting people will not be happy with this, but this is one of the one prime example of that, right?
Yeah.
So Srinivas, now that we think that it's not the right move, but we appreciate the spirit of it, because we are the ones who started talking about indirect evergreening. So we are not saying that indirect evergreening does not exist, but the way they have adopted, route they have adopted is not right. So have they, and there was a lot of backlash also when this was issued.
Yeah.
So I heard recently they have done some modifications to it. So can you throw light on the modifications, and then what do you think, and is that in the right direction, or you think more needs to be done?
Right. So yes, I mean there was a lot of pushback by the industry. So recently they came up with a revised circular. They made actually two main changes. One is they have now allowed the investment in AIFs if AIF invests in those firms, the borrowers, in the form of equity. As long as they invest in equity, which of course takes junior precedence than debt, they are fine with it. The second thing is
So it means as a AIF borrows from a bank, doesn't pass on to a borrower as a loan,
yes,
but puts in as buys some shares of that company, then RBI is not intervening. They're saying you can do this.
then it is fine.
So what they don't like is taking a loan and giving another using that loan.
Even hybrid instruments they have not allowed.
Okay.
And
So sitting with the IIT guy makes you also talk the same language. So can you explain?
Okay. Like some debts which have provisions to be converted into equity, all those things are also
So plain debt or is allowed, is not allowed.
not allowed.
And basically plain equity is allowed.
That's right.
Anything other than plain equity is not allowed.
Not allowed.
So anything which has some feature of debt is not allowed.
Is not allowed.
That's the way to understand. That's one. Yes. What
And
else?
then other was they gave a clarification in terms of the amount of provision that the bank has to make. So when you're so for instance, let's say SBI made investment of 100 crore into an AIF. And the AIF has made, has invested that 100 crore into 5 different securities.
Right.
And only 20 crore has gone to the debtor. Earlier it was
Debtor of SBI, borrower of SBI.
borrower of SBI. So earlier it was not clear, they were asked to make a provision of 100 crore. So now they have clarified that you don't need to make a provision for 100 crore. You need
So
to make
benevolent, right? They are so, so in fact they should have gone further, right? You thought of giving a loan and that's why you make provision. Maybe that's the only thing left.
Right.
So this is okay. That's but I understand both of them. I think we all agree that given where they started from, it's a better move.
Right.
But then why are you not satisfied?
Yeah, but I think they're still clearly way off from, it's still a very blanket kind of a rule which is having a lot of restrictions.
Right.
As Nishant already mentioned, it takes away the opportunity to take, to make some good investments for the banks and all. So there could be some improvements on it. See, if we go back to our main paper, this whole evergreening thing was happening when the main borrower was of bad quality, when the financials of that borrower was bad. So here I think they could at least make some kind of filter saying that that eventual borrower is not having a good credit rating or is not having good financials, then maybe you have these rules for provision or bar them from investing.
Right.
If it is a very good investment, why bar
So
them at all?
you are saying, let's say there is a borrower of SBI who's doing very, very good,
Right.
Who's AAA rated and doing excellent, and they happen to borrow from an AF, which is also borrowed from SBI. What's the problem?
What's the problem?
what's your business? You know, why should RBI restrict this at all? You know, what is the economic reason for, you know, there should be, that's why I'm saying, when policy makers, they ridicule economists saying that, you know, you're always talking about conceptual stuff and all that. But if you don't have any conceptual way of thinking, this is a problem. Why will a bank, a very healthy bank, evergreen a loan given to a healthy borrower?
Given to a healthy borrower.
Why? Right? So the basic thing that they have to at least they should have considered is that borrower should be unhealthy.
Right.
That's the first thing, right?
That's the first.
And then can I extend say that even the bank should be unhealthy?
Exactly. I mean, even our evergreening scenario holds when the bank is also unhealthy and the borrower is unhealthy. That's when it's a win-win situation for them to do evergreening.
Yes, because evergreening is not costless. Right. Even for the bank, eventually it will lead to more default in the future. So it is any kind of crime or any kind of thing when I do, I have to consider the cost that I may be caught. Right. Only when that cost is lower than benefits, that's where I do it. For a HDFC, it doesn't make sense to evergreen a loan given to a prime borrower. Maybe they would have considered HDFC through AF. Infosys doesn't borrow. I don't know whether TCS borrows. Let's say TCS, let's assume they borrow. HDFC gives a loan to AF, right, and AF invested in TCS. RBI is banning it. Is that right?
Yeah,
as per the current
circular. As per the current circular.
And they worry that these two guys are evergreening. This is crazy. And you can put filters. You know, you can put some filter. Right. You know, otherwise what you're doing, as Nishant explained, you are killing a genuine investment. Right. You know, you may be killing a lot of innovation. So on the one hand, we talk about startups, promoting startups and all of that. And if regulators come this way, and this can hurt. That's so while we really appreciate the spirit of this circular, that we are happy that RBI thought about indirect evergreening, yes, because the AQR completely missed it. That we really appreciate. But this kind of blanket ban, I think makes no sense. So policy should consider, you know, you can't completely ignore research. You know, you can't say this is academic and irrelevant and all of that. And you should consider, you know, at least the motive. You know, that is where some kind of thinking in using economic principles help. Right. So you have any other closing comments?
Yeah, I mean, maybe there could be, I'm not very sure, but there could be some other filters, like if you see the bank is just one of the investor in AIF and having just say maybe 20-30%. There are other investors also. So it could be possible that, you know, it's like other investors' decision is also there. It's not just SBI dictating what you want to do.
Sure.
So you have to see whether what is the stakeholding of the bank in the AIF. Then what is the stakeholding of the AIF in the eventual borrower? Right. If the AIF itself is very diversified, right, I mean, they won't be as diversified as a mutual fund, but if it is say diversified, it will be, you know, very unreasonable to say that, you know, it is.
They are using this, you know, why will they risk their entire reputation for this one borrower? So if the AF is created only for this purpose, then we understand, which is like our related party transaction. But the AF is investing in 1,000 people. For one borrower, why will they risk their? You know, people, I don't know why these things were not thought through. And I think we should, as India grows and as we become a more market economy, we should, you know, give up this habit of blanket ban. Right. We take pride in saying that, you know, we did not suffer from global financial crisis because we did not allow financial innovation. Right. We don't realize that we did not realize the benefits of financial innovation. Exactly. Right? So the same approach on crypto, just ban the whole thing. And when it goes down, then pat yourself on the back that I did not allow. Right? This actually hurts innovation. Right? So finance is important for innovation. Nishant, do you have any closing thoughts?
Yeah, just one.
You appear as frustrated as we two are.
So just one more thing. Because these AIFs, they fund these new age companies, these startups. These fundings also go to private equities, which then invest in startups. So maybe because you are closing down this one of the sources of funding to these startups who are expecting in the future that more funding will come through this route. Maybe these guys projects will start going bust because of this lack of investment, and then that may in fact increase the overall defaults in the economy.
And a bank may have more NPA. The whole circular which is designed to reduce NPA. Yes. This is what most of the bureaucratic rules end up creating. So you're saying if there is a project which is dependent on a bank and a AF,
Yes.
now they have to choose between one of
Yes,
those,
yes.
or find another bank. That's not easy.
Yes.
And if you suddenly pull this one source of
Right,
funding, that project may fail, and even the bank will suffer.
Right.
It is not that just the AF will suffer, even the bank will suffer,
Yes.
and there could be more NPS
NPS in the bank.
and not only that, the circular has killed a very new way, innovative way of financing. So that market itself will disappear. Now AFs cannot. Otherwise, where will you find a borrower who has not borrowed from ICICI or SBI? There are only so many banks. Unlike in the US, we don't have 1,000 banks here.
Yes.
You have 20. Now that with the merger, we have even few banks.
even few.
And where will AF find? Either AF has to stop borrowing from banks,
Yes.
or borrowers who borrow from AF will have to stop. One of these two.
Yes.
And this is an unnecessary restriction. I think this is clearly a policy where the costs far exceed benefits. And who are seeing this? Authors of papers who actually talk about indirect evergreening. We think indirect evergreening is a problem, but there are more sophisticated ways. Blanket ban is not the solution, right? This is they should think through and revise it even more. Good that they have started revising, but nowhere close to what it should be. Right now, our view is the costs far exceed benefits. Thank you so much.
Thank you.